Massive amounts of manipulation is going on in the silver markets, and it's caused bank collapse. And it's by the biggest bank in the world. And I'm going to tell you why today in this video that this is nothing new, that this is something that this bank specifically has done time and time and again. And it's all a part of their major plan to destroy the regional banks and so they can swallow them up over time. Now, I think that this is not something that we should be surprised to see from Jamie Dimon and JP Morgan, but I do think it is really interesting when you honestly see the amount of manipulation and movements that the silver market has made here recently, because it's honestly something that you would expect to see out of the crypto markets. It's something that you would not really expect to see from the precious metals. I mean, we saw 10% up in the day. And, what also you saw was China then imposed a ban on their, or a limit on their restrictions from their exports, which are going to happen in just a couple days. Now, China is one of the world's largest silver producers, refiners, and it's moved to now tighten that global supply. Now, what I think is interesting about silver, especially compared to the other precious metal like gold, is that silver is a smaller market cap than gold. So if you guys heard it from my video that I put out this morning, be sure to watch that after this, but be sure you're subscribed and hit that like on this. Regardless, when you look at silver, it has a smaller market cap than gold. So obviously, the players can move and manipulate the prices a lot easier than they can, say, the gold markets. And so silver generally moves a lot quicker than gold. But the interesting thing about silver is that in times of a recession or times where things get a little difficult, let's say, silver moves a lot quicker and a lot faster than other markets. And we've seen that. One thing that we saw at the beginning of this year was that silver was already at 100 to 1 for the gold to silver ratio. Now, the gold to silver ratio isn't anything new. They've been using this as a tale old of time. Isaac Newton, all of these others have been using this for quite some time. But the unique thing of this is that when you see major moves in this indice specifically, that's when you start to see signs of a recession. Now, with this, right? We might have lost us here. But with this, we're going to potentially start to see the silver markets and others start to move down. We've seen silver already crash down to 60 to 1 comparatively to the gold markets. And that's where I think we're going to be, right? Is where we're going to start to see these silver and gold markets really move in tandem. But when you see it move from 100 to 1 down to 60 to 1, that's when we get some hairiness. That's when we get some issues here. But we're going to get back to this and get back to playing ball, because I think that when you keep on going through the differences in the silver market and what we're seeing today, is that there's just massive amounts of movements here. So the banks can see your stop loss orders. So they've mapped out a pain threshold. They don't want you to see and ride with them to $100 silver, right? There's these arbitrage traders, right, from east to west, because we did see the same Chinese buyers buying silver at $90 when the United States sellers were selling at 75. And that is interesting, right? And shortly after we saw all this, right, the US banks, the Federal Reserve, pumped in billions of dollars into the banks to help avoid these crashes. Now, this is where I think it gets very interesting, because now the US Federal Reserve and the banks are now essentially admitting that there was some sort of issue. There was a flash crash at 2:37 in the morning, which means one of two things. Either that it was a coordinated attack from a United States bank, or it happened at a bank overseas. Most likely it happened at a bank overseas, and we started to see that when, we got one of these we got potentially a European bank or a giant over there crashing. Now, the other thing is that we see JP Morgan in these crashes start to swallow up some of the smaller players. In 2008, JP Morgan scooped up Bear Stearns. And when we see the financialization of a lot of these, products, call it housing in 2008, monetary, precious metals now becoming monetary metals here now. Well, I mean, silver at the end of the day is still very industrial. And so it hasn't really been used as a monetary asset until now. And now that it's becoming more and more industrialized, that shortage is causing a major supply squeeze. Now, my laptop's still messing up, so I'm about to close. When we keep looking at all of this, right? When we keep breaking all of this down, it gets very interesting when you start to see just how much this intertwining is happening between the two, right? Because there's 13% of the total silver supply is now in China, right? So it's a major aspect of it. Of course, it's in a lot of it is in, these other areas, but JP Morgan also filed this 8K in December disclosing that it had a bunch of unrealized losses in silver, right? And the interesting thing is that banks don't just collapse, right? They get rolled into these silver, or they get rolled into JP Morgan. So there was these rumors, right, that these major collapses happen. JP Morgan fired that. But the rumor claims that 34 and 7 billions, right? But here's what nobody's asking. Why did JP Morgan suddenly need to own 750 million ounces of silver after spending 15 years on the short side? What did they see coming that made them eat a $5 billion loss just to get positioned the other way? And this is where I think this all gets intertwined. It's essentially JP Morgan and Jamie Dimon manipulating the precious metals markets like they've done before to swallow up some of these small banks, right? The one unique part about the United States is that we have a lot of these small regional banks. Now, across the globe, and if you look at Canada, our friends to the Great White North, they've essentially just built out this model where it's just 5 to 6 major banks, right? So with these small amount of banks, the big players get funded, right? In the United States, these small regional banks, they have an advantage. If you want to go get a coffee shop at the corner of your neighborhood, you know the banker, you can create that relationship, you can do all those other things. Now, when you have this major banks only, that means the big players are the only guys that are getting money, right? Only the big dollar figures where they can see massive amounts of capital returns. So that eliminates or very drastically hurts the small businesses around the globe. So JP Morgan, they only want to deal with the big players and they want to swallow up all these little guys. So they've been convicted of manipulating these markets before. And so it's really no question that they would do this again, especially when we see silver and precious metal markets looking like this. I mean, look at this. It looks like it's almost a meme coin here, right? Where we're seeing a 10% swing up and a 10% swing down. I mean, it's absolutely massive, right? So when we continue to see things like this going on in the market, you got to ask yourself, is the market actually playing fair and easy games? Or are we seeing massive amounts of manipulation? And when you take a dive into the overall stock market and how, lopsided this is, it is very, let's call it sketchy, right? And maybe this silver manipulation is something that's hiding something bigger beneath the surface, right? So when you take a deep dive into this, global stocks hit 17% of the world's market cap. The last time it happened during the 2000 .com bubble. 6 months before the NASDAQ crashed 78%. Here's what the smart money is doing while you're chasing AI. Consumer staples, healthcare, the boring sectors. They've been down 7%. But the top 10 and everything else, it's getting extremely top heavy, like I said, folks. So all these other big players, they're selling tech now and starting to buy the consumer staples. So defensives don't need the tech crash, right? They just need the capital to remember that 16 times earnings with a 3% dividend yield beats 35x earnings with no yield, right? Most crowded trade in history is long AI. And I've been saying it for a time and time again on this channel that once everybody starts to get these same ideas and start to think the same thing, that's when we run into trouble, right? Everybody thinks that in the next 30 days, if the Fed cuts interest rates, we'll see massive amounts of liquidity flooding into the system. It'll all go to tech and AI. But it looks like from here, what we're seeing is the Fed not going to be cutting interest rates. So if they don't cut interest rates, what's going to happen? Right? The Fed's debt obligation is going to go up, and Trump's not going to be very happy. But that could potentially see some strength come back into the dollar, as we've seen the dollar have its worst year since 2017 and its third worst year. There's been 2 years that have been worse than this year since the 1970s, 1973 and 2017. It's crazy. So when we see the Dixie down, you got to ask yourself, what the hell is going on? Especially when we've got the S&P 500 floating at 6,900, right? So the dollar is down, inflation is up, assets are up, and we got the silver market going bonkers. I mean, this is like one of the craziest markets we've ever seen, folks. And I accidentally clicked stop share instead of this. Man, I've had some technical difficulties on this one, so I appreciate you guys sticking with me if you've made it all the way this through. But please make sure you smoke that like. You hit the subscribe button. You tell a friend to tell a friend. Help me get to 1,000 subscribers. I'm going to be bringing as much content as I possibly can to you guys. And I'll catch you guys all at the next one.